Assalamualaikum warahmatullahi wabarakatuh. My name is Ahmad Dani Shaikal bin Fauzi and my metric number is 1232668. So today I will be presenting on the comparison between two companies, which is Khind Malaysia and Panasonic Manufacturing Malaysia Berhad. I'm not doing this alone because I have three members of my group that will be helping me with the presentation today. So there will be section covering the financial ratios, strength and weakness analysis, and the recommendation for improvement. So we hope you find this section informative. So let's jump to the introduction. Panasonic Manufacturing Malaysia Berhad and Khind Holding Berhad, two prominent companies in Malaysia's consumer product and services industry, are compared in this research. Both businesses are listed on the main market of Bursa Malaysia and were chosen for this financial analysis study because they meet the requirement for Sharia compliance and steady profitability. Khind Holding Berhad is a domestic Malaysian business that was established in 1961 and has its main office at Section 23 Shah Alam, Selangor. Khind began as a modest electrical trade business and has since expanded to become a well-known producer and distributor of electrical industrial and household appliances such as home fans, kitchen appliances, water heaters, air conditioners, lighting goods and energy-saving gadgets are some of its main product categories. The business has grown both domestically and globally over the years, exporting to over 50 nations in Asia, Middle East, Africa and Europe. The company's business concept places a strong emphasis on quality, price and after-sales support. Besides, in 1965, Panasonic Manufacturing Malaysia Berhad was established as a subsidiary of the multinational Panasonic Group, which has its headquarters in Japan. The production and marketing of consumer electrical and electronic equipment, including as air conditioners, washing machine, kitchen appliances, hose cleaners and ventilation fan, is the primary emphasis of Panasonic, which is based in Shah Alam, Selangor. Strong technological integration worldwide, supply chain management and a dedication to sustainability and innovation are all advantage Panasonic Malaysia enjoy as a subsidiary of a well-known global brand through its exporting companies serve not only the Malaysian market but also the international markets. Both businesses have a big impact on how Malaysian consumer electronic market develop. Panasonic capitalized on its position as a global brand, while Khind is a powerful domestic brand. In order to ascertain whether business offers a more alluring investment prospect, this research will evaluate their financial performance using ratio analysis. So now I will pass to my friend to walk through the financial ratio.
Assalamualaikum and hi everyone. So my name is Ahmad Hakim bin Muhammad Ashraf. My metric number is 1232679. So in this part of our presentation, we will discuss the financial ratio for both Khind Holding Berhad and Panasonic Malaysia, which are two companies operating in the Malaysian electric appliance industry. So the main purpose of doing this financial ratio analysis is to evaluate and compare the financial performance, condition, efficiency and profitability of the two companies. For this analysis, we will focus on four main categories of financial ratio, which are liquidity ratio, efficiency ratio, leverage and solvency ratio, and the last one is profitability ratio. We will explain each category in the detail in the next slide. So let's move with liquidity ratio. So liquidity ratio helps us measure a company's ability to pay off its short-term debts and obligations using its current asset. We will compare three main liquidity ratio, which is current ratio, quick ratio, and cash conversion cycle (CCC). So for the current ratio, for Panasonic Manufacturing Malaysia, the current ratio is 5.1778, which means Panasonic have more than 5 times the current asset compared to its current liability. For Khind Holding Berhad, the current ratio is 2.4743, which is still good, showing they have about 2.47 times more current asset than liabilities. This shows that both companies are liquid. Panasonic has stronger short-term financial strength. For the next is quick ratio. For Panasonic, the quick ratio is 4.6256, which Khind's quick ratio is 1.6034. The quick ratio excludes inventory and focus only on the most liquid asset. Again, Panasonic has a higher ability to pay off immediate liability without relying on inventory. For the last is cash conversion cycle. This measures how many days the company takes to convert its investment in inventory and other resources into a cash flow. So for Panasonic, which is CCC is 30.6792, and for the Khind Holding Berhad is 115.5474, which is it takes them around 40 days to convert resources into cash. In contrast, Khind has much longer CCC of a day, showing that Khind takes more than 150 days to complete the cash conversion cycle. It suggests that Panasonic is much more efficient in managing its working capital and cash flow cycle compared to Khind. In summary, that we can choose the Panasonic Manufacturing Malaysia Berhad has stronger liquidity and faster cash conversion, make it more efficient in meeting short-term obligations. So let's move on the efficiency ratio. So for the efficiency ratio, efficiency ratio helps us measure how well each company is using its asset and managing its operation to generate revenue. We'll compare our 4 key efficiency ratio, which is inventory turnover ratio, average collection period, fixed asset turnover, and for the last is total asset turnover. So for the first one is inventory turnover. Panasonic inventory turnover ratio is 12.4817, and for the Khind is 3.5995. This means Panasonic is turning over its inventory around 12 times per year compared to only about 3.6 times for Khind. This indicates that Panasonic is more efficient in managing and selling its inventory. For the next is average collection period. For Panasonic, the average collection period is 35.5037, and for the Khind holding Berhad, 18.3977. On the other hand, Khind state 18.3977 days, which is more than double the time. This shows that Panasonic collect receivable much faster than Khind, improving its cash flow. For the next is fixed asset turnover. Khind has a higher fixed asset turnover, which is 7.4750 compared to Panasonic, which is 3.7370. This means Khind is generating more revenue per unit of fixed assets, which show better utilization of fixed assets like property and equipment. So for the last one is total asset turnover. So as shown that total asset turnover for Khind record 1.4533 compared to Panasonic is 0.9994. Again, Khind appear more efficient in utilizing its total asset to generate revenue. So in summary, that we can conclude that Panasonic perform better in managing inventory and collecting receivable, but Khind is more efficient in utilizing both its fixed and total asset. So for the next slide is leverage. So for the leverage ratio, which help us understand their financial structure and how much debt they are using to finance the asset. So for starting the debt ratio, which is Panasonic Manufacturing Malaysia Berhad, is it use less debt to finance its asset, indicating a more conservative approach. Next is debt to equity ratio. Panasonic stands at 0.16 and Khind stands for 0.27. Again, Panasonic shows a lower reliance on debt compared to shareholder equity, suggesting lower financial risk. Finally, the time interest and TIE ratio. So this ratio shows how well a company can cover its interest obligation with its operating income. So Panasonic has a significantly higher TIE, which is time interest earned, of 30.446, while Khind has a TIE is 2.430. This suggests Panasonic is in a much stronger position to meet its interest expense, reflecting higher financial stability. In summary, that Panasonic demonstrates stronger leverage ratio, indicating better debt management and lower financial risk compared to Khind holding Berhad. So for the next is profitability. So profitability ratio. Let's explore the profitability ratio of Panasonic Manufacturing Malaysia Berhad and Khind holding Berhad, which help us measure how effectively each company generates profit from its resource. Starting with the net profit margin. Panasonic reports a strong margin of 8.08%, whereas Khind stands at only 1.41% only. This indicates that Panasonic is significantly more efficient in converting revenue into actual profit. Now the return on asset, which is ROA. Panasonic's ROA is 8.689%, better than Khind holding Berhad, which is 2.09. So this shows that Panasonic is using its asset more than its generate earning. So for the return of equity, for the last is return of equity ROE. Panasonic has an ROE of 8. So Panasonic has ROE of 10.08%, while Khind has ROE is 3.36%. This suggests Panasonic delivering higher return in shareholder compared to Khind. On this slide, we focus on 2 key profitability metrics for the next slide. So let's move on to the next slide. It's also the profitability ratio, which has another 2, which is gross profit margin and operating profit margin. So as shown that gross profit margin for Panasonic Manufacturing Berhad is 11.82% compared to Khind holding Berhad, which is higher than, which is 29.76%. This means Khind is more efficient at managing the direct cost of production, keeping a larger portion of revenue after covering cost of goods sold. However, we shift to the operating profit margin. So for the Panasonic is 9.2%, is higher than Khind holding Berhad, which is 1.9%. This suggests that Khind has a strong gross margin. A lot of its revenue is consumed by operating expenses. So Panasonic, on the other hand, maintains better control over its operating costs. So in summary, Khind performed better at gross level, but Panasonic demonstrated stronger efficiency managing operating costs and maintaining profitability throughout its operation. Panasonic outperformed Khind across all profitability indicators, reflecting stronger operational performance and better value creation for shareholders.
Hello, my name is Muhammad Farish Aiman bin Adi, number metric 1232666. So for the next part, I will explain to you SWOT analysis, which compare the strength, weakness, opportunity, and threats of a Panasonic Manufacturing Malaysia Berhad and Khind Holdings Berhad. Both is an active company in Malaysia electrical and electronic industry. Although both operate in the same sector, they differ in market segment and business scale. So for the first one, let's start with the Panasonic Manufacturing Malaysia Berhad, or PMMA. As a subsidiary of the Global Panasonic Corporation, PMMA benefit from a strong brand reputation and high market valuation. Its products are known for durability and innovation, particularly with a strong presence in the high-end appliance segment. However, Panasonic premium pricing and some operational inefficiency can pose challenge. This is reflected in its relatively low asset turnover ratio despite high profitability. In terms of opportunity, PMMA is well positioned to grow thanks to Malaysia's role as an E&E hub, with rising consumer demand both locally and across Asian market. On the trade side, the company faced rising production costs and intensifying competition, which could pressure margins and affect market share if not managed effectively. Now let's proceed to the next slide, which is I will explain to you SWOT analysis in Khind Holdings Berhad. Khind is a local Malaysian brand that caters to the mass consumer market with a strong domestic and growing international presence. It has built strong brand recognition and a broad product reach, especially in affordable and mid-range appliance. Its main weakness is, however, lie in a market limitation and cost structure. Khind operates primarily in the mid-market segment and has limited export penetration compared to larger players. Looking at the opportunity, Khind can take advantage of Asian trade growth, increased demand for smart appliance and digital expansion through e-commerce and strategic partnership. But similar to PMMA, Khind also face competitive pressure in a saturated market where price wars and brand loyalty are key to survival. In conclusion, this SWOT analysis reveals that while Panasonic holds strength in brand prestige and innovation, it must improve efficiency and cost control. Khind, on the other hand, has room to scale and innovate further in its growing markets, but needs to address its profitability and export limitation to compete globally. Understanding this internal and external factor help us better assess their investment appeal, market strategy, and long-term competitiveness in Malaysia's dynamic E&E industry. Now let's move on to the SWOT analysis, specifically focusing on the strengths and weaknesses of both Panasonic Manufacturing Malaysia Berhad and Khind Holdings Berhad based on the financial ratio we have evaluated. Starting with the Panasonic, one of its key strengths lies in a strong liquidity position. It has a current ratio of 5.18 and quick ratio of 4.63, which clearly show that the company is more than capable of meeting its short-term obligation. In addition, Panasonic demonstrates excellent working capital efficiency. This is reflected in its cash conversion cycle of just 30.68 days, indicating effective inventory and receivables management. When we look at the profitability, Panasonic also performs well with a net profit margin of 8.08% and ROA of 8.69% and ROE of 10.08%. These figures highlight the company's ability to turn sales into profit and deliver solid returns to its shareholder. Lastly, Panasonic maintains a low financial risk shown by a very low debt to equity ratio of 0.16 and an outstanding interest coverage ratio of over 30,447. This means that the company has a minimal reliance on debt and is in a strong position to meet its interest obligation. Now, we look at the Khind Holdings Berhad. Its main strengths are in asset utilization, and it has a fixed asset turnover of 7.48 and a total asset turnover of 1.45, indicating efficient use of its resource to generate revenue. Khind also has a strong gross profit margin of 29.76%, reflecting effective cost control and pricing flexibility. So we proceed to the next slide, which I will explain to you about the weaknesses of the two company. However, Panasonic does have some weaknesses. One notable issue is its lower asset efficiency. The total asset turnover is only 0.999 and the fixed asset turnover is 3.74. This suggests that its asset base may not be fully optimized to generate revenue. Additionally, Panasonic gross profit margin is only 11.82%. Possibly due to the high manufacturing costs or pricing strategy limitation. On the other hand, Khind's weaknesses are more prominent in liquidity and profitability. The current ratio is 2.47 and the quick ratio is 1.060, although acceptable are lower compared to Panasonic, which may limit its short-term financial flexibility. Moreover, Khind faced challenge in working capital management with a long cash conversion cycle of 150.55 days, suggesting a slower inventory turnover and collection processes. In terms of profitability, Khind underperformed with a net profit margin of only 1.1%, ROA of 2.09%, ROE of 3.36%, which are significantly below industry standards. It also shows higher financial risks with a debt to equity ratio of 0.27 and interest coverage of 3.43. To summarize, Panasonic is financially stronger in liquidity and profitability, while Khind show better efficiency in asset utilization but struggles with profitability and working capital control.
Hi, my name is Azim Najambi Arba'in. My metric number is 1232645. Next, we go to the recommendation for improvement for both company. We go to the Panasonic first. Firstly, improve asset efficiency. To improve the total and fixed asset turnover ratio, re-evaluate idle or underperforming assets. This could entail investing in more productive technologies, reorganizing asset or selling underutilized asset. Next, enhance gross profit margin. Reduce the cost of production per unit by investing in economies of scale or negotiating better terms with suppliers. Next, invest in innovation. Build new high margin item by utilizing the parent company's R&D capabilities. This will assist boost sales volume and profitability. Next, expand market reach. Investigate new client groups or regional market, especially in ASEAN, to capitalize on the high brand equity and boost sales. Lastly, optimize liquidity use. In order to prevent opportunity costs, PMMA can investigate more effective way to allocate excess current asset into high return investment or business expansion. Given the extremely high liquidity position, current ratio is greater than 5. Next, we go to the Khind company. Firstly, improve working capital efficiency. Through better forecasting, stricter credit control, and order processing automation, the business should concentrate on shortening the time it takes to keep inventory and speeding up the collection of accounts receivable. Next, reduce financial leverage. The business should think about lowering its reliance on outside borrowing and paying off high interest debt. To support capital needs without adding to debt load, retained earning might be strengthened and equity financing could be investigated. Next, strengthen liquidity. By better managing its liabilities and keeping its existing asset structure more balanced, Khind can increase a short-term financial flexibility. Next, expand export strategy, which is present in more than 50 countries, or to enter more rapidly growing emerging market. International revenue stream can be improved by strengthening distribution alliance and digital sales channel. Lastly, enhance investor confidence. To increase market trust, Khind should concentrate on informing stakeholders about its clear financial goals and growth ambition, including consistent dividend policy and open reporting procedures.
So now we already walked through the financial ratio, the SWOT analysis and the recommendation for improvement. To conclude, resting on the analysis and evaluation of the financial position of Panasonic Manufacturing Malaysia Berhad and Khind Holding Berhad, one can conclude that both companies perform effectively in the Malaysian electricity appliance market, however with different levels of financial and efficient operating power. For overall financial stature, currently the Panasonic Manufacturing Malaysia Berhad is financially better of the Khind Holding Berhad. In terms of liquidity, Panasonic is very liquid with the current ratio of 5.18 and quick ratio of 4.63. Very much profitable, which is the net profit margin is 8.08%, ROA is 10.76% and ROE is 11.3%, and low financial risk. Debt to equity is 0.16, interest coverage ratio is 447. On the contrary, Khind Holding Berhad being efficient in terms of asset exploitation and having a good gross profit margin, which is 29.76%, has worse liquidity and leverage as well as the majorly worse profitability levels. In addition, for future growth and efficiency, Panasonic also has a better opportunity to achieve sustained growth thanks to its healthy internal cash generation. It's like debt burden and its source of innovation and backed up by its global parent company, which is stayed in Japan. It has a sound financial status that enables it to make strategic investment in research and development, market development and product development. Despite its financial limitation, Khind is also promising on the basis of its wide coverage in the export business and efficiency in utilization of assets. Nevertheless, it should fit its poor cash conversion cycle and leverage to unleash additional values. So lastly, we're going to talk about the recommended investment. It is advisable to the board of directors that it invests in Panasonic Manufacturing Malaysia Berhad. With Panasonic, there is more security on the monetary front, steady stream of positive cash flow, and the risk factor of investment is low and thus an easy option to invest. Where Khind could have a potential in certain niche market or long-term strategic alliance. But Panasonic is the better alternative in terms of return, which could be attained in the short run and long term. So that's all from us. Thank you for listening and thank you for lending your ears.